IRS just released the updates for the 2024 Roth IRA contribution limits, income limits, and the phase-out range. I'm also going to go over how this is going to change your way to contribute to the Roth IRA or the Backdoor Roth IRA conversion if you're over the income limit. Roth IRA is on step 6 of my financial independence checklist, and it's one of the most important investment steps I take in order to achieve my financial independence number. You can check out the brand new website I just launched, and you can download all of my financial resources for absolutely free by visiting firestarchat.com/resources. And you don't even need a credit card to sign up for the membership program. IRA contribution limits will increase from $6,500 to $7,000 starting on January 1st, 2024. And the catch-up contribution limit for those of you over the age of 50 will remain the same at an extra $1,000. So in 2024, you'll get to contribute up to a total of $8,000. And also in 2024, the income phase-out range for taxpayers making contributions to a Roth IRA is increased to between $146,000 and $161,000 for single individuals and heads of households, which is up from between $138,000 and $153,000 in the tax year 2023. And if you're married and filing your taxes jointly, the income phase-out range is increased to between $230,000 and $240,000, which is up from between $218,000 and $228,000. And if you're married and filing your taxes separately, the income phase-out range is still not subject to the annual cost of living adjustment, so it will remain the same at between $0 and $10,000. And let me show you how the phase-out range works for the Roth IRA. If you're a single or a head of household making less than $146,000 a year in modified adjusted gross income, then you can directly contribute to your Roth IRA from your checking account with a maximum of $7,000 if you're under the age of 50. If you're turning 50 years old in the year 2024, then you can contribute an additional $1,000 or a total of $8,000 directly to your Roth IRA. However, if your income is somewhere between $146,000 and $161,000, then you have to manually calculate how much you can contribute to your Roth IRA. If you make, let's say, $147,000, then you might only be able to contribute up to $6,750 instead of $7,000. Fidelity actually has a really good calculator that you can use by just Googling the Fidelity Roth IRA income phase-out range. If your income is more than $161,000 as a single individual or $240,000 as a married couple, then you can't make any direct contributions to your Roth IRA. And the same rules apply for married filing taxes separately. Then you can't make any direct Roth IRA contributions. So if your income is above those limits, then you can do what's called a backdoor Roth IRA, which I will go over the backdoor Roth IRA process after I explain the deductible contributions to a traditional IRA, because it has everything to do with the backdoor Roth IRA. For the traditional IRA, the income limits for non-deductible contributions will also increase starting in 2024. For single individuals covered by a workplace retirement plan, your contribution to a traditional IRA is fully deductible if your income is less than $77,000, which has increased from $73,000 in 2023. The phase-out range is also being increased to $77,000 and $87,000, which is up from between $73,000 and $83,000 in 2023. If your income is above $83,000, then it's considered a non-deductible contribution in 2023. And starting in 2024, it'll be $87,000. And remember the word non-deductible because it has everything to do with a backdoor Roth IRA, which I will explain later on. And for married couples filing taxes jointly, the spouse making the traditional IRA contribution is covered by a workplace retirement plan. The phase-out range is from between $123,000 and $143,000, which is up from between $116,000 and $129,000 if the spouse doesn't have a workplace retirement plan like a 401k and is married to someone who is covered. The phase-out range is increased to between $230,000 and $240,000, which is up from between $218,000 and $228,000 in 2023. So your income will need to be pretty high or above $240,000 in order to have your traditional IRA considered as non-deductible contributions. This could become even more difficult to do a backdoor Roth IRA conversion if you and your spouse don't have 401k, 403b, or some other type of employer-sponsored retirement account. And I'll go over the backdoor Roth IRA process later on in this video. And if this is all confusing to you and you're interested in joining my private client program to get financial coaching and financial planning services, you can schedule a free consultation with me by visiting firesightchat.com/coaching. I also recently launched a brand new website where you can sign up for a free membership to get your free financial resources like the Roth IRA calculator by visiting firesightchat.com/resources. You do not need a credit card to apply whatsoever. These financial resources are absolutely free for you to use.
For free. For free.
And the income limit for the saver's credit is also being increased, adjusted by inflation. And saver's credit is for low and moderate income workers, and it's going up to $76,500 for married couples filing taxes jointly, which is up from $73,000 in 2023. If you're a head of household, it's being increased from $54,750 to $57,375. And if you're a single individual or a married couple filing taxes jointly, the income limit is also being increased from $36,500 to $38,250. And if you don't know what the saver's credit is, it's also known as the Retirement Savings Contributions Credit, which gives a special tax break to low and moderate income taxpayers who are saving for retirement. A Transamerica survey showed that only 12% of Americans making less than $60,000 a year are aware of this tax credit. So how much you can claim the saver's credit will depend on your adjusted gross income and your tax filing status. You can claim the credit for 50%, 20%, or 10% of the first $2,000 you contribute during the year to a retirement account. So you can claim $1,400 or $200 in total tax credit. And if you're filing your taxes jointly as a married couple, the biggest credit amount you can claim is $2,000. But keep in mind that if you take any money out of your retirement account during the 2 years prior to the due date for filing your tax return, that $2,000 could be reduced depending on the size of the retirement distribution. And something else to keep in mind is that the saver's credit is considered a non-refundable tax credit, which means that you can reduce the tax to $0 if you owe any taxes, but it can't give you a tax refund. So if you owe $1,000 in taxes this year and you're getting back $1,500 in saver's credit, then your tax bill could be reduced to $0, but you're not going to get that extra $500 back. So be sure to get with your CPA if you're not sure what you're doing. And if you want to read more about the traditional IRA and Roth IRA changes for 2024, I'll put the IRS link in the description below. And I also have a full Roth IRA tutorial video that you can check out on my channel. And let's talk about the backdoor Roth IRA for 2024. And I'm going to make an extended video about this in the future, but let me just give you a summary of it. Remember when I went over the traditional IRA income limit for non-deductible contributions as a single individual is at least $83,000, right? If you're married and filing your taxes jointly with a workplace retirement plan, the income limit is $143,000. If you're married and filing your taxes jointly, but you're not covered by a workplace retirement plan, then the income limit is $240,000. So keep these requirements in mind so that what you contribute to a traditional IRA is considered non-deductible, which will matter for the backdoor Roth IRA conversion process because it is considered an after-tax contribution to your traditional IRA. So with the contribution limits in mind, if you're under the age of 50, you can contribute or convert up to $7,000 in 2024. If you're over the age of 50, you can convert up to $8,000. Then you can convert that $7,000 from a traditional IRA to your Roth IRA at any time during 2024. This is not a taxable event because that non-deductible contribution you made to your traditional IRA is considered after-tax dollars. the IRS can't legally tax you twice on your retirement, but you have to make sure that you file what's called IRS Form 8606 to identify your traditional IRA contribution as non-deductible. And what I plan to do, which is not in any form of personalized financial advice to you, is to contribute all $7,000 in January 2024 and then convert all $7,000 to my Roth IRA at the same time before I invest in any securities. When that $7,000 gets to my Roth IRA, then I start dollar cost averaging my index fund by $270 every 2 weeks. And I might even do to $135 every week. It just really depends on my investment preference. And here's some ways to schedule your automatic IRA contributions for 2024. You can choose to contribute on a monthly basis between January and December 2024, which is $584 a month for 11 months and $576 for December. If you're over the age of 50, you can schedule your contributions to $667 per month for the first 11 months and then schedule $663 for the month of December. But if you think that's too much, that's okay, because the IRS actually allows you to contribute to your Roth IRA until the tax deadline on April 15, 2025, or what I call the extended contribution period. So assuming that you're contributing on the first of every month, starting on January 1st, 2024 until April 1st, 2025, that's a total of 16 months. So if you're under the age of 50, you could schedule your IRA contribution to an even amount of $437.50 a month. And if you're over the age of 50, then you can schedule your IRA contribution to an even amount of $500 a month. And if you get paid on the 1st and the 15th, then split your contributions to 24 times between January and December, or split your contributions to 32 times from January 1st, 2024 until April 1st, 2025. If you're going to schedule 32 times, just make sure that you don't do it on April 15, 2025. I would try to do it on April 13th or 14th to make sure there are no issues with your broker. And that might be cutting it a little bit too close to the tax deadline. And if you get paid bi-weekly or every 2 weeks, then split your contributions 26 times between January and December. Just be careful if you're going to spread your contributions going into April 2025, because it's going to depend on your paycheck schedules. Whatever you do, try not to go past the tax deadline on April 15, 2025. And I know this is a lot of information, so I'll make sure to leave the chapters in this video so that you can navigate it when you work on your IRA contribution schedules. But whatever you do, please don't skip on any Roth IRA contributions. Once we pass the tax deadline, you can't go back to the previous tax year to contribute to the Roth IRA. If you haven't fully contributed to your Roth IRA in 2023, you have until April 15, 2024 to maximize the contribution in the amount of $6,500 or $7,500 if you're over the age of 50. And I started maxing out my Roth IRA in 2016. And for the last 8 years, just by investing in simple index funds, I have just over $60,000 in total tax-free investments. It doesn't seem like a lot now, but if I keep maxing out the contribution every year for the next 25 years, I should have well over 7 figures in total tax-free investments by the time I'm in my 60s. This is going to be huge for my retirement because it's going to be tax-free distributions. So make sure to visit my website at firesidechat.com/resources to get your free Roth IRA calculator if you haven't done that already.